offer to come help,
That
but
didn't work very good.
no. In case anyone missed it.
Look how strong I am. Strong like bull.
This is why I'm scared of my dad. I'm 33. He's old. He's been hit by a car. He's got a bad back. Still scares the shit out of me. Wow.
That didn't work out.
You all right?
Well, I marked up the wall too. Cindy's gonna
Oh, no. Tell Mom that you were attacked by a grizzly bear. But don't.
All right, welcome to Real Estate 100, where we talk all things real estate, and I guess we could keep it real. Is that corny to say we're going to keep it real in real estate?
The cheese is pretty high on that.
Hey, we'll have lots of cheese on this show, I'm sure. So my name's Nolan Matthias. I've got with me Miles Nowik and Greg Nowik, and we have started a show, I guess. I mean, this is real now, right? Like, we're doing it. There's a background, there's a logo, there's three guys in beards with sunglasses.
Yeah.
It looks like it's a real thing. I think let's start first and foremost, as this is the official first episode. Let's talk about how this all came about. And I think I have to start with the story of Miles calling me a few months ago and saying all these nice things about me and my YouTube channel and how he's learned so much from me. And I had to break the unfortunate news to him that I learned everything from his father and that he had direct access to everything that I learned. But it matters who says it in many cases. And sometimes the father is not the best person to teach the son, because sons don't listen. I know that from
we don't. We're notoriously bad at it. I find it funny too, because I feel like I've inflated both your egos with one statement, and I love it. I think it's great. No, I thought that was hilarious. I know, I've wanted to break into like sharing information on YouTube because, in my age group with millennials, there's nothing out there, right? Like, there's very minimal information available. So I always wanted to jump into this. And then I remember I reached out to you for some advice and, was telling you about how much your stuff taught me. And your dad taught me that. Oh, good. So I just completely missed all that. Went right over my head.
Who's your dad, Miles? We should get him on the show. Actually, it's quite funny because, I think it goes generation to generation because, I remember my dad used to try and teach me stuff and I would go, what the heck do you know, dude? Like, you're an old guy. And so we don't necessarily listen to our fathers, which is sometimes a huge mistake, because rather than learn from our own mistakes, we can learn from theirs. And I remember my grandfather, who was my dad's father, telling me, and he was an old Ukrainian guy and he was amazing, but he would say, you learn from your friends and your family and your coworkers, never learn on your own. And you know what? Sometimes we smarten up and we get her done. So I'm now learning from my 84-year-old father now, even as we go. So we should probably have my dad and your dad on the show too, Nolan. That would be kind of cool.
I think that'd be cool. And my dad's got ties to the mortgage industry as well. He used to work for BMO in the broker channel, and former realtor. And I think there's going to be some exciting guests. I know we've already got Tony Spagnolo, the lawyer, lined up, and probably going to have some interesting conversations there around how to do mortgage fraud. So stay tuned for that. He's going to give
that's going to be so cool.
Teach
everybody how to do it.
Yeah, is it a training session or is it information? Tune in and find out.
A little bit of both, right? And then I'd love to bring the QR codes kills kittens guy, Scott Stratton, in. I think he'd be a pretty funny guest, especially considering that he is very clear about his hate for realtors, which I think will resonate with the audience of any real estate show. Literally, I don't know if you've ever seen him speak, Miles. I know Greg has. I think I remember being in a room with Greg when we were both hungover about 10 years ago when Scott Stratton was speaking. So I think we had changed shirts that evening. Obviously,
I think we got on a bus. There was a bunch of other stuff. Yeah.
Anyways, that's not for the show.
There's stories that I don't know that I really think we should sit down with a bottle of whiskey. We'll hatch it out. I need to hear them.
I'm sure they'll come out at some point. But Scott, if you've never seen him, is hilarious, because he comes out, and if he's speaking to realtors, he will come out. First thing he'll say is, I hate you guys. I hate realtors. And they'll think he's kidding, and it'll just be deadpan. And then they realize he's serious.
Wow. And hate's a strong word, but
that's his words, not mine. I'm quoting, and he would have no issue with me quoting that. So I think he would be a fun one. And And I think there's a lot of other really amazing people we could have on here in the next next year as we try this. We've committed to a year to see how this goes, and then we'll see what happens. But I think the better and the more controversial people we can have on, the better, right?
Absolutely.
Yeah, it keeps it interesting. That's for sure.
Totally.
His Scott's company is, what is his company name?
Unmarketing.
Yeah.
Unmarketing. Yeah. On leadership, unlearn. They got a lot of cool stuff. So
I think he was at the last big conference we were at, wasn't he, Dad?
Mm-hmm.
Yeah.
In Vancouver. And of course, that's a nice thing that's happening now too, is that, you know, after the C word, COVID, we were in a position where, you know, we were locked down. We couldn't do anything. Now all of a sudden we're going to these conferences again and we're listening to people. And that's in any industry. It doesn't matter where it is or who it is. But now they're able to go and see these people speak, as opposed to, you know, a lot of it watching online, which is also phenomenal. But it's kind of cool to have a good mix of both of those things, obviously.
Yeah, it's getting fun to see people again. That's for sure.
Absolutely.
You know, and at some point we're gonna have to do one of these shows where the three of us are live and in person as well.
Well, let's do that in August.
Little fishing trip.
Oh,
maybe.
I think we should make a bet for that one too. I really do.
A beard shaving bet?
I don't know about a beard shaving bet, because I have the biggest beard out of all of us, I think. I don't know. Nolan might be giving me a run for my money, but I don't know. I think
I would grow mine just for that. But here's the other thing that's really cool. Is it up in Cayuga, which is the west coast of Vancouver Island, about 2/3 of the way up there when we go fishing. In the summertime in August, it's warm out. Not as warm there, and the water is still pretty cold.
So what I'm hearing here,
they have a huge dock, and I think that, you know, maybe the loser has to dive into the water. Or be thrown into the water.
Oh no, I think it's got to be voluntary. You do a flying leap right in there.
Isn't that the area where all the sewage is drained into from that little village there?
Oh, that'll even be double there.
No, that's on the right side of the dock. We'll get you to jump off the left.
You assume that it's going to be me that jumps in. I see how this goes. Okay.
Well, I mean, we don't even know what the bet is yet, but I think it's established that we need to make one, and the loser of this bet jumps in the ocean when we're away fishing.
Off of Dave's boat.
Ooh, when we're actually way out there too, and then
no, get close.
I'm kidding. Kidding.
Too funny. I love it. It's going to be a lot of fun doing a bunch of this stuff. With respect to the kind of this, well, let's kind of just give the quick rundown of who we are. So,
sure.
I run a company called Mortgage 360, who my viewers from my YouTube channel will be familiar with. You guys run a company called, I guess it's called Nowik Mortgage now. You guys made a recent change in branding and networks and whatnot, which is cool. You're obviously my favorite BC mortgage brokers out there. And I can say that because there's literally nobody else I like in BC. I think I feel the way about mortgage brokers that Scott Stratton feels about realtors.
There's a lot of great people in British Columbia, I'll tell you. We're not the only two. We're the top. We're in the top.
We're pretty good, though.
30,000 or so, but yeah.
You're my favorites. And I think really with this show, there's going to be a little bit of talk about mortgages. There's going to be a little bit of talk about real estate, but we're really going to try to make it as broad as possible. So this is probably going to be the one show where we actually get like the baseline of what our ideas are, how we feel about, you know, banks versus non-banks, fixed versus variables, buying or waiting, affordable housing, all that sort of stuff. But, you know, I'm honored because Miles is not only a great up-and-coming mortgage broker, he's also an amazing drummer. Greg is one of the best in the industry, former mortgage broker of the year. You only get to keep that for 1 year, and then you can never tell anybody else ever again, right?
Yeah.
You didn't even show up to get your trophy when you won that, did you?
I know. It's funny because it's nice because we all have a diverse background, right? So, you know, I'm a pipe fitter by trade. Started worked for Xerox for a bunch of years because there was no work in pipe fitting, and I got into a sales position and did some training there. My boss, who is one of my mentors, who's an amazing guy, lied about my education and said I had a degree. So, you know, and then when I tried to get promoted, they wouldn't do it because they asked for my designation. Of course, I didn't have it. But, and then got into the mortgage business in 89 with the TD Bank, and then became a broker in 91. So I think a lot of people in general have not done one career. Like I know, Nolan, you've got a tremendous background and you're a phenomenal golfer. Like everybody has got a history, right? And I'm not sure that we decided to become mortgage brokers. Miles will tell you the same thing, but boy, are we ever glad we're doing what we're doing to help people. It's really neat. So it's pretty cool.
Oh, 100%. I always thought I'd be a world famous drummer, but you know, that's a pretty big dream. And I guess this, you know, this meets the expectation. I'm just kidding. No, it's you know, it's one of those things where it's a lot of the times it's not what you know, it's who you know. And I grew up around this industry. When I remember doing spelling test practice on a whiteboard in my dad's, when we lived in Vancouver, I was in like grade 3, and it was in his office. So he'd be working on files. My mom would be teaching me that you don't spell the word 7 with the number 7 in front of it. Yeah, it's just it's one of those things. And when I finally fell into this position and fell into being a mortgage broker and a planner, and more so working on not just the mortgage side of it, but the people side of it, and trying to come up with strategies and ideas for people where they didn't really have any guidance, it was like something clicked. That's the spot for me. It's where I need to be.
You still write 7 with the 7 in front of it, don't you?
Oh, absolutely.
Yes, he does. Yeah. Well, and you know, it's funny too, because I think we were kind of excited because Miles's passion was music and his music, and playing the drums. Like their band, Wise Young Blood, is playing in Nanaimo at one of our local places on Saturday night, and that's the first time in 3 years. They also were in the top 100 in Spotify last year in North America. So it's just, I mean, but he also, you know, unfortunately through COVID, C word comes up all the time, that, you know, it was unfortunate because it sort of slowed them down on that process.
Oh,
it killed it.
But he dug into this industry and found passion for it. And, you know, there again, him being able to reach out to people like you, Nolan, who, you know, you're extremely successful in the industry, you and your lovely bride, and a great operation. And it's just being able to talk to people and figure out what's next, which is really cool.
Yeah. And I think the great thing about this combination is we've got Miles, who's coming at it as a new father in a very short period of time here.
October 10th.
We've got October 10th, hey? Yeah. And Papa G's already a papa, but he's going to be a papa again. And then we've got Greg coming at it from, you know, what was that? 30 years of experience, 1991.
1989, 32 years.
33 years.
Yeah.
Right. And then for myself, you know, I'm kind of in that middle of the move up type of buyer, you know, have a 10-year-old son, and we've kind of got a bunch of different perspectives. And, you know, when we were leading into this conversation today, we were talking about how we were talking about inflation, and I don't think we'll get too much into inflation on this conversation, but we were talking about how people were who keep talking about the 80s and how this is so similar to the 80s, and then how it's different from the 80s and everything else. And, you know, I think it's an interesting conversation because of the perspective that different generations have. And I love that that's what we're going to be able to touch on this show and in this channel, is the fact that we've got these different generational ideas and thought processes. You know, we will be transferring the knowledge directly from Greg to Miles by talking about it on this show, which is also good. And then, you know, bringing in guys who have maybe been in the industry for a long time, or like maybe we bring in the dads and the grandpas, and maybe we bring in some of the guys who've been around a long time and who can say, you know what, this isn't like the 80s because interest rates aren't 18 or 20%. They're only 4.39% on a 5-year fixed right now. And that's historically really freaking low. So quit telling me this is just like the 80s and everything's going to hell in a handbasket, because it's not. And I think when you look at what's happening, at least right now as we're recording this, with respect to economic data, we're seeing inflation come down. We're starting to realize that the economy is actually really strong outside of inflation and higher interest rates, and that maybe things aren't necessarily as bad as we thought they were, right?
You mean the sky isn't falling?
It doesn't seem that way.
Oh,
so,
okay.
I mean, I think that leads us into kind of the first piece of the conversation there. And let's talk about the skies falling. You know, let's talk about affordability. Let's talk about housing prices. Let's talk about the reality of what's actually happening out there. So tell me a little bit about what's going on in your neck of the woods. Obviously, you're on Vancouver Island. I know you guys do a lot of business on the mainland as well. And this is one of the most expensive real estate markets in the world. Are houses still affordable? Are people still buying? Like, what's happening in these expensive markets that you guys are so closely tied to?
Well, I think it's funny because in the lower mainland, we went through 2 years ago, went through multiple offers. Nobody's putting, they're not selling their house before they're buying. There was all kinds of huge issues going on with people 2 years ago. And all of a sudden it stops, it slows down, it starts to drop a bit. Well, everybody you talk to on the mainland now says, hey, we're back into multiple offers again. I think things have settled down and they're stable, but it's still expensive to buy a home. But in the same respect, in our market area, we've seen a lot of people that are not living in downtown Vancouver anymore. They're moving out to the rural areas, right? So, and before, where Burnaby and Coquitlam and Port Coquitlam were affordable, now people are moving to Mission and Abbotsford and that kind of stuff. So that's happening on the mainland. On the island, specifically in Nanaimo, when we moved over here, when Miles was, God, that was 25 years ago. So you were what, 8?
I was in grade 3.
Okay, so moved over when we were 8. There were 64,000 people in Nanaimo proper, and now there's 115,000.
Yep.
And they figure that's going to double a lot faster than it has in the last 25 years. So, and on our street, for example, there's I think there's 4 brand new people that have moved in that have come here from the mainland because they now work from home. So, it's the prices locally here, people think the prices are high, but they're not. Right. So, the bigger centers, obviously it's more expensive and you may be having to buy a home with a basement suite in it, but that's how we did it before. So, we bought jokingly, we talked about it the other day, but bought my first house in Victoria in 1983. I think I paid $62,000 for it. My interest
What's
rate
it worth now?
17.5%.
Yeah, but what's it worth now?
I don't know, $1.3 million.
I'd say more than that. If it was,
was
it downtown Victoria?
Yeah, it's Fort and Foul Bay. It's kind of in an older area, and it was a 1911 house. So
you can say it's like a $1.5 million house at this point.
Yeah, but
it's crazy to think about for me, though. I mean, like when I talk about house affordability and stuff like that too, and I mean it's different for me because I'm also 33, right? Like I haven't seen the peaks and the valleys and the different cycles that other people have seen. But like when I look at it, it's okay. So you got a house that's worth $60,000-$70,000. And then 30 years later, it's worth $1.5 million. How much money, like respectively, were you making at that point in time? Probably, I think I've heard this story, so I know the answer.
Yeah,
like 70 grand between you and Mom.
Yeah, between Cindy and I, we're probably making 60,000 between the two of us.
So I mean, when we look at affordability, just with the prices and how they've moved, that house is worth $1.5 million now. Have incomes gone up to match that? And in my opinion, the answer to that is no. And we can't, of course, just boost incomes to match what the cost of a house is. That's not how it works, but it's something that should be taken into consideration when looking at the actual aspects of affordability, right? Because if all of a sudden something's increasing in value by hundreds of percent at a time and income isn't going up that fast, you kind of get stuck in that spot of how do I qualify? How do I buy this home? How do I get into it? And I think that's when you really want to look at it and start working with professionals who work in that industry and talking to them before you actually even start looking, because you want to build that strategy behind it. Because, you're not having an income to debt servicing ratio of, equal value. You're way off. You're making 150 grand a year and buying a house that's 1.5 million. So you have to have those strategies.
What's the market like in Calgary, Nolan? Like, give us some feedback on where you've seen things going and where it's been.
Yeah, I mean, I can talk about that. I do kind of want to circle back to what Miles was just talking about there, though, because that's one of the big fallacies and one of the big issues with, there's guys out there who are real estate doomers, and they use this price to income ratio, and they say if it gets past 4 or 5, that's when things are going to hell in a handbasket. And what price to income ratio neglects is it neglects the fact that interest rate costs come down or mortgage rules change. So when Greg bought that house ages ago, like 400 years ago, right? Sorry, Greg.
When it was
he actually had to use a hammer and chisel to sign the paperwork.
Yeah, exactly. So I mean, at that point in time, interest rates were higher. Yep. You had to get a 25-year mortgage. you know, he probably had to put considerably more down, and it was a different, there was different criteria there. So that's the problem with that, you know, with that ratio that's often used by guys like Garth Turner. And I mean, the guy looks at that ratio and tells everybody, well, real estate prices are going to go down, and eventually he's going to be right. And he was right here the last couple of years, or the last year or so. But the problem is when you look at economic data and you look at it from the perspective of something that doesn't tell the whole story, it holds all else equal when not all else is equal. It's called ceteris paribus in economics. That's where you kind of, it creates issues for the real estate industry. And then a consumer grabs onto that and is like, oh shoot, this ratio's out, so I shouldn't buy a home. And it's like, well, yeah, but you forgot to factor in the other 9 things. So
yeah,
you know,
well, I think that's, sorry,
go ahead.
Oh, I was going to say that's where like having a group like this is valuable, because like I said, I don't have all the data. I don't have all the knowledge and the information, because I mean, I can read as much as I want on YouTube. That's not going to compare even close to the knowledge that Greg would have when it comes to having a mortgage in the 80s. Like, I can watch everything I want, but until I hear it from someone who's gone through it and lived it, you don't know, right?
Well, and yet we talk about sort of a generation before me, because I am older than dirt, but you know, at 30, 31, my dad is 84, and, you know, they had a house in Victoria that was, they were paying 18, 19, 20%. And, you know, when they sold in 1981, what a terrible time to sell. And I think the key there is that to get into the housing market just saves you having to pay rent. So at least you're saving something.
Yeah.
And I think that's what people forget, is that if my payment is $300 more than what my rent is, still 40% of what my total payment is going towards paying my principal down. So at least I'm saving some money, and I don't have to save for buying a house anymore. And it's just some simple things that people forget about. The other thing that we saw is when I started in the industry, people would buy a condo in Vancouver, and then they would upgrade to a townhouse, and then they would buy a little single family, and they would sort of go from there. Whereas now we've seen so many younger people that want to get into that third home already. Like
they kind of want to skip the line, right?
Yeah.
And,
and also seeing people, you know, and getting parents to help, because you know what, like I always say, like, help your kids, because when I bought my house, it was $62,000. So, you know, we've got to make sure the kids can get into the housing market. And parents bought their first house at 62, and it's now worth $2 million. Like, you got a ton of equity, help your kids out.
Well, that's where I was talking about strategizing too, right? Like, I mean, one thing I found with working with a lot of first-time homebuyers and young people who are getting into their home, and I mean, we're seeing first-time homebuyers getting, dare I say, older. Like, you're not buying your first house in your early 20s anymore. Some people are, but you know, it's more common to see them push a little bit further. And a lot of them don't want to ask their parents for help. They don't want to ask for that help. And I keep telling them, like, you know what, there's no shame in asking for that assistance in buying the house, because it does give you that foot forward, because you're immediately building equity in that property you own. It's like a forced savings account. And I mean, even with interest rates where they're at right now, you're still building equity. You know, it's don't be ashamed to ask for help. Everyone needs help.
Have you guys seen the most recent stats out of Stats Canada with respect to owning a home and the net worth benefit at retirement? It's like, so they look at all these, they looked at this broad scope of people, and specifically they looked at renters versus owners at retirement, and renters on average had a net worth of $40,000. Guess what homeowners' net worth typically was? $700,000.
Yeah.
So this and this is what drives me crazy about like YouTube, right? Is when you look at when you go on YouTube and you go and you look at some of the channels about personal finance, like there's this one guy, his name's Steve Antonioni, makes amazing content, and did an amazing video on renting versus buying that made it seem like renting was the better option. But what it discounted was the fact that psychology comes into play. And when you're renting versus owning makes it so that you have to put money aside every single month. It's a forced savings account. Renting, on the other hand, in theory, could be deemed as something that is more financially beneficial if you actually went and put a whole bunch of money aside every month. But it's like what psychology tells us and what history tells us is that people don't do that. So the single fastest way to build a net worth and the single most certain way to build a net worth is to actually own a home and then also do the saving on top of that. Now, I brought up this housing affordability index because the one thing I see with millennials a lot, and I think millennials get a bad. I'm a millennial. My wife is not. She's older than me. I thought I'd put that on the show just so I could get in trouble later.
Yeah, you're yeah.
I mean, I just texted her and said you said that.
Perfect. We might have to edit that out. But millennials get a bad rap for being entitled, right? But the one place where I see a lot of millennials be really entitled is when they look at the first home that they're going to buy, and they're expecting to buy an average home,
right,
at an average price at a less than average income because they're just new into the workforce. And what I find really interesting about RBC's housing affordability index, which I think is probably one of the best statistics in the industry, if you want to see where your markets are, and they break this all out by individual city and whatnot. And by the way, it's forecast that affordability is going to get better over the next year or two. But what I look at is this number with respect to condo apartments, and we know as mortgage brokers that 40 to 42% of income is kind of where housing is affordable and where it's not. And if you look at where condo apartments are, they're very much affordable if you look at Canada as a whole. Now, there's going to be markets where they're less affordable, markets where they're more affordable. But if a millennial comes into the market with the expectation that they're going to have to start at an entry-level property, which is not a single-family detached home, then and purchase that property, build some equity, and then eventually be able to purchase a bigger home and get into that one that they're going to be able to have a family in, then they're starting with the right foot forward. Now, the big problem for a lot of millennials is they spent the last 10 to 15 years skipping the entry to the real estate market. And now they're so far behind. The question is, are they ever going to be able to purchase the house they need? Because now they've had 2 kids.
Yeah, now they got the family and
everything else, right? So,
well, that's where the bank of dad and mom come into play. Like, and honestly, there are ways to do it that people don't even know about, right?
Yep.
So, and there's cost-effective ways of doing it. And there again, do I buy a condo or do I buy a home with a suite and I'll use dad's line of credit for my 20% down to bypass CMHC? Like, there's some things you can do, and then it covers the nut, right?
If I can share my experience, like when I first bought my first house, I was renting. Of course, my dad had built the house. I was renting the suite from him. This is like what, 7, 8 years ago.
Yeah.
And it worked
best
great.
Best day of city of my life was when Miles moved out of the house.
I thought it was when I moved back.
Not because you left. It's because it gave you the independence to grow.
Oh, okay. I thought that was going to go in a complete other direction. I was about to tell people, like, plug your ears.
No, we want you back all the time.
No, it was interesting though, because like I was going to rent, right? Because I was renting a place for my parents and they were going to sell it, right? It was time to sell it. And I was like, okay, well, I'm going to try and find a place to rent. And I'm looking around and my dad looks at me and says, well, why are you talking about that? You work in mortgages. Buy a flipping house. And I said, I don't have enough money to buy a house. I don't. I haven't saved up enough. I've been stupid with my money. It is what it is. And he said, well, here's what we'll do. And we structured it. So he had a line of credit on his house. I borrowed from that. I put 20% down. And I mean, this was, 6 years ago, right? So that means, I bought it at about $362,000, but I managed to scrape together, and I was making way less. By all intents and purposes, I had to have a roommate and the basement suite, but I bought the house with the basement suite. And I had to pay my dad $500 a month towards that line of credit, right? I was paying the interest, a small amount of principal, paying the interest down. And
was there a gift letter involved in this whole scenario here? Should we maybe be like editing this out?
Actually, no, because we also went on title and we factored in the line of credit amount into our debts, right? So and the part of it is that instead of 25-year, you go 30, and then Miles, you can finish it up.
Well, and essentially, so they were on title, like you said, they were on title of my house. And to be fully honest with you, when it boils down to it, I'm pretty sure if I looked at Dad and said, "Oh, Dad, I can't afford to pay," he'd be like, "Fine,
down payment." I'm not allowed to say that. Bullshit. No, you have to pay me.
But no, I think I know Greg well enough to know that he would kick your ass out in the street and make you get a job.
Yeah, then he'd rent the entire house out. No, but it was interesting because I managed to buy this larger asset, right? And recently, me and my wife just we bought the house we're in now, and we kept that one as a rental. And the reason we were able to do that is because I had this basement suite. I got to pick what I wanted to pay, especially as my income went up. So as my income was increasing, I was like, okay, I'm paying $600 a month towards my mortgage. I can clearly afford to spend more. What's that going to do? So I crunched the numbers, boosted my payments, right? And I wasn't paying anything obscene. It was still cheaper than rent. And all of a sudden I had all this equity in the house. So we refinanced, bought this place, rented the entire place out. And I mean, yes, we're struggling a bit now because rates have gone up. And of course, I missed the boat on locking in because I decided to go to Hawaii and turn my phone off for 2 weeks. Never doing that again. But at the same time, thankfully, we have that rental property because we're going to be okay. We're going to be totally fine. And it was just that simple. I had the conversation with my dad saying, this is the house I want to buy. This is why. Presented him. I pretty much showed up with a PowerPoint presentation on why it was going to work. And then we went for it, you know?
Nice. So your example earlier, Nolan, with, you know, the couple buying the condo, well, maybe they don't have to sell it, even though when they do sell, there's no capital gains and so on and so on.
Yeah.
But maybe they keep it rented out and buy another one. Like, you know, there's things that people, and if we all said, oh, God, if I only knew then what I know now, I would have kept every house I ever bought, right? Because I'd be a gazillionaire.
I was gonna say, I distinctly remember sitting in your office one day with you. You had clients, and you were letting me sit in, and you said exactly that.
Yeah.
Like, if only I could have kept every single one I ever bought, and the only thing I ever regretted about buying real estate was selling it.
Yeah. So I mean,
they kept the house on Princess Street.
There is a part to selling because it makes sense for you to get into the home you want, but also we're very Canadian, right? So. And unfortunately, you know, there again, parents, I think, do want to help their kids, but I think kids sometimes are pretty proud. And the other part that's been really tough is that, you know, our kids are growing up in nice homes. Yeah. And so now all of a sudden, when they go to buy that first home, like you said earlier, it's maybe
there's
not
that expectation.
Yeah. So, I mean, we just gotta, and that's where sometimes we just gotta help out. It's not a big deal.
Yeah. And if that option doesn't exist for somebody, you know, like you said, there's other options there. I mean, house hacking, buying something with an up and down suite.
Yeah.
You know, there's lots of ways to get into the real estate market right now. And I think, you know, with respect to everything that's happening in the economy, we could see a downturn at some point. But right now, it doesn't look like that's happening anytime soon, especially with the number of new Canadians that are coming into the country. So let's
even buying with your brother, buying with your sister. Like, you know, the nice thing about the new rules in the mortgage side is that if you decide to separate, you can refinance through CMHC, right? If you're a brother and sister, like you would if a marriage separation. So there's some cool stuff out there that you can do.
Totally. Amazing. Let's kind of move on from that piece of the conversation. Let's talk about banks versus non-banks. And, you know, I think it's 2023. We can definitely all agree that if you're going directly to your bank now, you're doing it wrong. And, you know, I say that coming from the place of, we have 3 mortgage brokers on this show. But I mean, at the end of the day, like, if you aren't aware about big bank penalties, if you aren't aware of the fact that a lot of the banks don't want you to talk to a broker or don't deal with brokers because they don't want you to have independent third-party advice, and if you aren't aware that there's a really good chance you'll get a better deal, the right mortgage, and a better product from dealing with a broker or dealing with bank or non-bank lenders that deal in the broker channel, you know, just take a look at Scotiabank with an adjustable rate mortgage. They deal in the broker channel versus all of the other banks that have variable rate mortgages with fixed payments that people are feeling the pain from right now. So there's something to be said for having independent advice. And in 2023, if you're going to your bank, it's just like you're doing it wrong. But from the perspective of banks versus non-banks, I know this has changed. I know Scotiabank, when I got in the business, was my number one lender. They got everything. Now at the time they were Maple Trust, and then they became Scotiabank. They got bought by Scotiabank, and you know, now it seems like that shifted. It seems like not everybody's a big bank client anymore, especially if there's a chance that they're going to have to move and they've got a 5-year fixed mortgage, or when you look at the benefits of things like adjustable rates versus variable rates. Where do you guys stand on this with respect to the whole bank versus non-bank conversation? And just before you answer that, I need to be 100% clear. And it's okay. You guys might have differing opinions on this, but I need to be 100% clear on this. non-banks are not B lenders. So when you look at companies like MCAP, when you look at companies like First National, when you look at companies like Home Trust, CMLS, these are not B lenders. The banks will tell you they're B lenders, but let's call a spade a spade. These guys deal with prime borrowers, and the only reason that they survive is because they have superior products. Because if they didn't, they wouldn't survive. They actually
100%.
have to have a better product because they cannot skate on their marketing budgets and their big bank brands, right? So where are you guys at on this? Banks versus non-banks? Like, what are you guys seeing with respect to clients? What do you recommend to people?
Honestly, sorry.
I was going to say, and one last question, where are the circumstances where you see clients going to banks versus going to the non-bank lenders?
I mean, from my perspective of it is, for one, if you look at the bank and they're going to tell you that the monoline lenders are B lenders, that's just not true. And that's, to me, is wrong to say that. Because, I mean, if you look at our lenders like MCAP, First National, CMLS, any of the ones you just mentioned, like, they offer great products. They offer the same lending options. It's just all they work in as mortgages, so they're called a monoline lender, right? And then if you look deeper into it, especially for someone who's a first-time buyer, if you're a first-time home buyer and you're going with, and I hate to pick on anyone, but RBC, CIBC, TD, Bank of Montreal, dare I continue, if you're going with any of those big banks, you're setting yourself up for big penalties, because there's a very solid chance you're going to break your mortgage term. And if you're in a fixed rate product, all that goal of boosting your down payment with equity, just kiss it out the window. They'll hit you with a big penalty. It's gone.
I think the big difference, like after doing this for 33 years, was when I started, we had one bank, Charter Bank, TD Bank, and we had Inland Savings and Trust and a bunch of little guys. First Line Trust was huge, right? And they ended up getting bought out by CIBC, and they were amazing because they had a 1/4 point discount on rates. And then TD came up with $4 per thousand for your mortgage on a cashback. But I think what really happened was that people wanted choice, right? That was the thing. So if I'm going to my bank to get a mortgage at my bank, the only products they have are the products they have. Whereas when you're talking to a good mortgage broker, you know, they're going to give you options and choice, and that's the key, and transparency. So, you know, and different lenders pay you different things and everything else, but in the same respect, it's all about what fits the parameters of the client. And cheapest is not always best too on the other side of the spectrum. So I you know, from our perspective, like I've dealt with MCAP for going on 28 years. And, you know, they were probably one of our biggest lender supporters and have been historically in the last 30 years. And it's because they've been consistent, and they had better prepayment privileges, but it's what the customers required. So we matched them up with that. Scotiabank, for example, has a phenomenal mortgage line of credit product called STEP. It's unbelievable, right? So does Manulife. So does National Bank. So TD now is offering the same kind of product. So there's some really cool stuff out there. But in the same respect, the monoline lenders now are starting to do those products as well. So, and you're right. The big thing, penalties is a whole 1 hour conversation. So let's not
do a
get
full
into
episode
that
on
crap.
Penalties.
Yeah, there's enough content on my normal YouTube channel that people can go and check out on that one, that we don't need to bore them for an hour on that.
Yeah.
No kidding.
Yeah.
No, and it's,
but then,
oh, sorry. But like, for example, you go into, let's say you go into RBC and you're talking to the RBC mortgage person. Is he going to tell you about TD's mortgages? Is he going to tell you about CIBC?
Well, actually, they will tell you about TD's mortgages, because they'll tell you how the TD has the different variable rate thing and all of that stuff, right?
Yeah,
but they're only going to tell you the bad things about the other guy's mortgage.
Yeah, they're not going to tell you the good.
Yeah.
Right. So meanwhile, and that's, you know, I mean, I don't mean to toot my own horn here. Well, I'm tooting all of our horns here, but when you go to a broker, it provides that option. It provides you the ability to say, hey, here's First National, here's MCAP, here's TD if you want it, here's Scotia if you want it. You can look at whatever you want, and we can go through all the fine details of each individual product between bank and non-bank and make sure that you get a mortgage that suits your needs, right? I mean, I've always kind of looked at it as not really a bank versus non-bank sort of situation. It's what's better for the client. Like, for example, you got someone who's got 3 rental properties. Hey, having that Scotia Step, that might be a really good option for you. Versus you got the person who's putting 5% down to buy their first house.
Totally.
You know, totally.
And that's kind of where we come at it from with our clients is, typically the first-time home buyers are almost always a monoline lender client because they don't need the fancy stuff that Scotiabank does in their step with the line of credit and all of that stuff, right? So when we always look at it as like the starter mortgage is almost always the monoline, and then when people start getting into doing the investments and the other stuff like that, that's when they start to find themselves into more in the Scotia steps and more bank type products.
Yeah.
That, like you said, Greg, a lot of the monoline lenders are trying to do now anyways.
Well, it's funny because I know one of the things that we do as a group is we give what's called a CMO, or competitive mortgage offers. So it's actually comparable offers from different lenders, and it could be the one that they deal with. So, and they can look at, because all the stuff comes right off the website. So it's completely transparent. I think that's the beauty of it. And I think that we've seen in the past where, I mean, when my first mortgage, I prepayment privilege. What the hell is that? Right? Like, how can I pay my mortgage down faster? Whereas now, you know, when you're dealing with a good professional person, you know, you can say, hey, look, like Miles said, my income went up 10% last year. Hey, if I increase my payments by 10%, I'm going to reduce my amortization by a year and 3 months. Like, it's simple stuff like that where it's educating people and making sure they know how they can pay that debt down, even though it's $1 million mortgage. We know that it's not going to take us 25 years to pay it off. It's going to take us 21. So if we're 30, we'll have our mortgage paid off at 52. So math.
Wait, are you using me as an example with the $1 million mortgage thing since I bought the other house?
No, we got to find another place for you.
Did you buy $1 million house, Miles?
No, but I have 2 houses and 2 mortgages. That is, my total mortgage is up over about $1 million. But
geez, wow.
Like I said, it's all about strategizing and planning. And even with rates jumping up the way our interest rate was like 1.8 when we got them, and now, I mean, as people have seen, they've jumped up dramatically. But we're gonna be okay because we strategized it and we structured it between non-bank versus bank. You know, I mean, I've got one property with a non-bank mortgage on it, and then I've got another property with I'm going to be very open about a Scotiabank mortgage on it, so that I could have that home equity line of credit in case something goes wrong with the rental. You know, I mean, if the worst case, I got a phone call that both the washer and dryer in both units went, and I'm like, cool, hit the line of credit, buy the things I need to buy, pay it off as I could, and you're off to the races. So it's really, really dependent on what you're looking for and what you need.
Yeah. I'm going to guess that all 3 of us probably have Scotia step mortgages. Am I correct?
I'm willing to bet.
Now,
I'm pleading the fifth.
Now, this knife cuts both ways, too, because while there's a benefit, a distinct benefit to non-banks, there's no question a significant benefit to brokers. There's also the other side of the equation where there are mortgages, there are mortgage companies, not that maybe aren't necessarily the best idea. There's different types of mortgages where you pay a significantly lower interest rate. And for some reason in our industry, people can't connect the fact that if they pay less, they're getting less, right? It's like I go to the Ford dealership and I can look at an F-150 and the base model is $30,000, and then there's the Raptor R that costs $250,000, and you're like, oh, that one's better and it's faster and it has more stuff. But when it comes to mortgages, it's like that one's 4.39 and that one's 4.89. They must be the same, so I'm just going to pick the cheaper one, right? So it's and a lot of that comes down to. I think Angela Calla was the one where I picked it up from first. She's a broker in Vancouver, a really successful one, and she talked about products and penalties, and how those 2 things were very, very, very important. And I think that's something that, you know, it's not just bank versus broker, and it's not just bank versus non-bank. It's what are your exact needs, and then what's the best deal you can get based on those needs, right?
So Miles brought up a good point earlier where, you know, statistically, I'm not exactly sure what it is because I'm old and my mind is going, but, you know, people stay on their mortgage for how many months on a 5-year term?
It was a couple years ago, it was 3 years.
Yeah. So
3 or 4 years.
Months. So, and, you know, life changes, life happens, and, you know, divorce, all kinds of things that can change. So, you know, you got to make sure that you have the ability to make that change. And I think that that's what Angela was sort of alluding to, is that, you know, there's stuff out there with, you can't refinance the mortgage.
You mean one of those horrible what's it called, a bona fide sales clause?
Yeah, so you cannot refinance your house unless you sell the home. Like, and people don't know about that. Or the other thing that kills me is my penalty is only going to be 3 months interest. That's what they said. That's what they told me. Well, it says 3 months or IRD, whichever's greater. So, you know, I think that's the key, is that, you know, you get what you pay for.
Yeah,
100%.
And you don't know what you don't know, right? People, like, you have blind spots when it comes to mortgages, and it's like, the doctor analogy is way too overused, but if I walk into a doctor and he starts talking in medical terms, he knows way more than I do, and I have a ton of blind spots, and I'm never going to have the knowledge he has. And in our industry, you can tap into that knowledge of really, really smart people who have been doing this a long time, and it's totally free. And you can make the argument that, oh, the lender's paying you, so I'm paying you, and everything else, and whatever. But it's actually going to be essentially the same cost if you go directly to your bank or if you go to your broker. The difference is, with the broker, you're going to get that independent third-party advice. And the nice thing about the regulators in Canada is they've pretty much made it impossible to do something from the perspective of being unethical with respect to putting somebody in a mortgage where they're getting paid because you're getting paid more, and so on and so forth, right? Especially in BC, where you guys have to disclose every single penny on every deal, right?
Yep. Yeah, we got that Form 10. And that's one of the nice things too, is like, one thing Greg and I have really focused on with the industry and with our, you know, arranging mortgages in our practice, is that level of transparency. It's paramount to us. We want you to not only just see the best option, we want you to see why it's the best option. And then we're going to tell, and like, I have had that conversation with a customer where they're asking, like, how I'm paid. And my reference is, I'm paid by the bank, you know, and 9 times out of 10, I don't have to charge a fee if we're doing a traditional mortgage. And I will disclose that information to you. And they look at me kind of like I got two heads. Like,
yeah. So, I mean, moving on to the big question. This is the question that, oh man, do you guys know the amount of abuse I've gotten off of this question on my YouTube channel over the last few years? So my advice has not changed at all since I started having this conversation on YouTube, or even with my clients in the last 5 to 10 years. And it is, you take the lowest rate at the time you can get it, because that is statistically what will work the best. Now, there's going to be outlier times where interest rates go up a bunch, like they did recently, and where you don't end up winning. And this last couple of years, it's like interest rates could have just as easily stayed low as they could have gone up by as much as they did, right? Like, if a ship doesn't get stuck in the Suez Canal, and if China doesn't have a zero COVID policy, and we are in a completely different world. If the supply chain issues aren't there, we're probably on a gradual increase in interest rates, not a fast increase in interest rates. So I've taken a lot of abuse on my channel on this from people who go, you told me to get a variable and now I'm screwed. And it's like, well, I don't remember seeing your application in my system. And by the way, if we would have had an application from you in my system, we would have had a conversation about risk tolerance, and then you would have made a decision based on risk tolerance rather than trying to time the market. Because I'm pretty sure that, you know, as a consumer, as an investor, as an anything, that you don't try to time the market, and when you do, you end up losing all of your money, right? And that's really the conversation we've had the last couple of years. So I'm curious, from your guys' side, how do you guys help people make the choice between fixed versus variable rates?
I cover my eyes, put some options in front of them, leave the room for 20 minutes. They circle one, I come back. I'm just kidding. No, it's I think you really touched on it really well there. It's that level of risk tolerance. You know, I mean, if, for example, I use myself as an example. So I carry variable rate mortgages right now. Did I miss the chance to lock in? Absolutely. It happens. You know, it can happen to anyone. But when it boils down to it, I work in mortgages on a daily basis. Every single day of my life, I'm going to be working in this. Well, hopefully I'll retire one day, but at this point in time, I work on them all the time. So my risk tolerance is through the roof. I'm quite tolerant, and I know what I believe, I know what I feel. But when it comes to the customer, it's not only your risk tolerance, but it's also what you personally feel, right? Like, if you got a customer sitting there saying, hey, no, I think rates are going to continue going up. I think this is going to happen. I think because of X, Y, and Z, you know, this is going to happen. Well, if that's how you feel, you should definitely avoid a variable, because you're going to lose
Especially
sleep
if there's
at night.
fear involved, right?
Yeah. If you're going to lose
100%.
sleep at night, don't take the variable. But at the same time, I also bring up the conversation around annual reviews and like being in touch constantly. Like with a lot of our customers, we touch base with them on an annual basis just to say, hey, like, how are you doing? What's going on in the mortgage market? What do you need? And one thing I found with these annual reviews is, yes, rates have gone up dramatically, but even my customers that hold variable rate mortgages, they're like, we're okay. You know, we qualified at a much higher interest rate because of the stress test. You know, it's tight now, but we're okay. And then occasionally you do get those customers that are like, we're not okay. We need some help. You say, okay, how do we fix this? What do we do to adjust these numbers to get it more affordable for you? But like I said, I mean, you really did touch on it. It's all about risk tolerance, and it's all about what's going to suit the client's needs.
I think
was that a proud, I was going to ask, was that a proud papa moment where you're like, yeah, that's what I would say?
Exactly. He you know, I mean, I think the other thing too is, you know, when you've gone through a lot of years of doing this business and you were traditionally a fixed rate guy before, I mean, I paid out a 7-year term on a penalty when it was like 11.5%. And, you know, we thought we'd died and gone to heaven when 5-year interest rates went single digit. Like, we went, oh my God, this is amazing. 9.95 for 5-year money. So, you know, I mean, I think we've seen some history with that. And I think the key there is that budgeting is the most important economy to anybody is your own personal economy, right? So sitting down and doing your budget, figuring out what your costs are. And as your income changes, like Miles says, I mean, he's doing it, man. He's doing exactly what he's supposed to be doing, which is amazing. If your income goes up, bump your payments up. If you can afford more, pay more, because we're creatures of habit. We spend what we make, right? So I think that I'm still, you know, I mean, I don't have a mortgage, but that's okay. If I did, I would have a variable rate mortgage.
A Scotia step.
He's silent on that one.
Or a Manu One. Like, there's some cool stuff out there, right? Like, there's some real cool stuff out there. So
yeah. And I think this kind of goes back to that conversation we had about banks versus non-banks. This all comes down to risk tolerance, what's right for you. And at the end of the day, like, having some help and knowing what your blind spots are on making those decisions. And that's it. Like, and, you know, anybody who's pissed off because they chose a variable rate, I mean, first of all, they got to ask themselves, did they personally choose that rate? Then they need to ask themselves, did they have the information they needed to choose that rate? And if they did, then, you know, it's one of those things in life where life happens.
Yep.
You made a decision and yeah, it was the wrong one. By the way, Miles, you talk about like being away and not locking in at the right time. I don't think there was a point in time where throughout that entire period that it made sense to lock in. Like, when you looked at it, at every single time, the variable rates were considerably lower than the fixed rates until they weren't, which was really late in the rate hiking cycle. So I think the mistake there would have been trying to lock in, because that's trying to time the market, and that's where you lose, right?
So, well, and it's, you know, I mean, I anytime I talk to customers about it too, I make a reference to a crystal ball. There is no crystal ball in life. You can't see the future. It's just not possible. Even in economics, you can't see into the future. You can take data, you can make predictions, and very, very accurate predictions. But at the end of the day, things can happen that throw a wrench in the system. And I mean, I'm not greedy. I mean, if I could just see like 3 months into the future, we'd all be loaded. But unfortunately, I can't. So what we try and do is base things on the information available and try and guide people based on that information. And as we've seen, you know, I mean, unfortunately, the rates, they said they were going to stay low. They didn't stay low. They said it'd be slow increases. They weren't slow increases. These things happen, but still sticking with that variable. I mean, I am a fan of the variable rate mortgage. I have definitely been converted by my father. I was always about the fixed. Now I'm about the variable. And the reason for that is, you know, I mean, if we look at this on a silver lining basis, which I always like to do, right now you've been forced, if you're in a variable or an adjustable rate mortgage, you've been forced to make a higher payment. Now, let's say rates go down next year or in 2 years or whenever. Were you comfortable making that payment? Yes. Can you keep making that payment? Yes. How many years did you just knock off your mortgage? And if you're paying 60 to 100 grand every 5 years on your mortgage, you knock 5 years off. There's the math right there, right?
Yeah, totally. Pen drop.
Drop it. Well, it was supposed to be a microphone, but I didn't want to drop this one. So
yeah, no, we're gonna have to get you a microphone you can drop. Hey,
just a cheap one that he can just drop every once in a while.
Yeah, what goes up must come down. Like the other part, I think that if I'm not mistaken, I had a friend of mine. I think it was Tony, and I remember his dad used to have a pretty cool comment, and he used to say that tomorrow's going to be a new day. Like tomorrow's going to be a new day. So let's not worry about what happened historically. In the past, if it's been painful, we know that we're going to get out of this. So I think that's the key. Things are going to get better.
By the way, just one quick distinction for the audience. There's two types of variable rate mortgages. Yes. In the sense of like industry terms, if we talk about variable and adjustable, they're both variable rate mortgages. Yes. Variable is typically a mortgage that has a fixed payment. That's the big bank type of variable that a lot of people are going to feel a lot of pain from. And then there is adjustable rate mortgages, which is what Scotiabank and a lot of the monoline lenders do, where your payments actually adjust. But they're both variable rates. It's just one has a fixed payment, the other has an adjustable payment. And the adjustable payment is the one where you feel the pain as it's happening rather than later when your mortgage comes up for renewal. And if we want to go broader into definitions, for all intents and purposes, a 5-year fixed mortgage is an adjustable rate mortgage from a global term. It just adjusts every 5 years rather than when the actual interest rates change. So that's kind of like the quick definitions on those things.
I can't remember which video it is of yours that you talk about that, but it is one of my favorites because I'd never heard anyone refer to a 5-year fix like that. And I heard you talk about it that way. I was like,
oh, you go to the States and they go, your mortgages are 5 years. And you're like, yeah, how long are yours? And they go, well, 15 or 30. And it's like, well, ours are every 5. And as a result, and we have another big thing, which is that IRD, so which is those big penalties that come with those 5-year adjustable fixed rate mortgages. It's from a product perspective, I think the US actually has some of the best products in the world with respect to their actual mortgages and how they structure things there.
Well,
I can go down there.
Yeah,
absolutely. So last question, and we'll do a little bit of a lightning round on this as we close out the show. There's a lot of people right now sitting on the sidelines trying to figure out if it's the right time to buy or if they should wait. So from the Nowik's perspective, junior and senior, what are we telling people? What's the move?
Oh, I got a good one on this. Nolan, you're going to blush. I'm going to quote you.
Oh, boy.
Are you ready? I'm not going to quote you exactly because I can't remember exactly what you said, but essentially said something along the lines of, if you want to buy a house and you are financially stable and ready to purchase that house and you can afford it and maintain the payments, buy your house. Don't wait. If you can't afford the house, don't buy it. If you can, you should buy it because it's impossible to time the market. It is next to impossible. And if you look at real estate as a long-term investment, not I'm going to buy it and sell it in a year and make a bunch of money. But if you look at it long-term, you're going to make your money back on it.
Yep.
But I think and like you guys are right. Like if it's affordable and you can do it, it's so easy because right now the rental market is crazy too in specific areas where, rents before were a lot less. So if you're a young family with 2 kids and you want to rent a place in Nanaimo and a small single family house, you're $3,000 a month.
Yep.
So what does $3,000 a month get me? Well, that probably gets me enough to buy the home or the townhouse or the half duplex that I want. And instead of spending $3,000 a month, which just poof disappears, at least if my payment is $3,000 a month, $1,200 or $1,400 of that is going to my principal every month. So even if the house never goes up in value, who cares? Within 25 years, if you just write regular monthly payments and the rates stay the same, it's paid off. Yep. So that's just, for me, I'm a math guy. So
I think in short, it's basically if you can afford to buy the house and you want to buy the house, buy the house.
Yeah. Pretty much, eh? And again, we talked a lot about risk with respect to selecting mortgages, and I think that also plays a significant role. It's like if the house that I buy, is it a 10-year play? And if I am buying it on a 10-year play, am I going to be able to afford it and be able to maintain that property without going into foreclosure between now and 10 years from now? Because I'll tell you what, 10 years into a mortgage, 10 years into owning a property, things start to look a lot different after you've had 10 years of getting used to it and 10 years of income increases and all of those things. So, you know, I think
one of the
getting
things
in.
I always told Miles, I said, if you ever get stuck, rent the house out, move back home with us. Like, there's always something you can do. Yeah, I did. I say that out loud.
Oh, me and Quinn are moving back over the moment that kid's born.
I know.
We're bringing us, our baby, and our dog. You better finish the top of the garage.
Wait until you see the expenses on that new baby. Those things are not cheap.
Everyone keeps telling me, they're like, you think your mortgage is expensive right now. You just wait until the baby's born. That's gonna blow it out of the water. To which you know,
weddings, university, and you know that comes into play too, right? Like, you know, when we're moving into our first house, you know, what do we have to plan for? Well, right now we're just planning for today, but you know, that's where sitting down and going through your budget and figuring stuff out, because everything changes every year.
Exactly. Right? So when the baby's born, we're going to rent out this house and move back home with Greg.
Right on. Yep. And I'm not giving you the baby presents anymore. It's our ESPs, right?
Perfect.
Nice.
See, that's another thing we could talk about. We got to get off the topic of babies, or else this episode's going to go on for another 2 hours.
I know.
Well, let's not do that then. No, you know, if I go back and do it all over again, and I look at the first property I bought as with a partner in a relationship, I'd probably go back and reduce the amount that I bought by a couple $100,000. And, you know, we always use like 39% of income going towards mortgage costs, including taxes and heat. I'd probably go back and reset that for myself at 25 to 30%. And I'd either do that by buying a smaller house or buying a similar sized house, but buying something that had a legal suite that I could rent out the basement or something like that. I
got a quick question before we, you know, move on here. Nolan, how old were you when you bought your first house?
So the very first property that I owned, or that I wrote an offer on, I speculated. I was 18 or 19 years old. I took possession of it when I was 20, and then sold it. Ring, ring. And then I sold it.
Sorry, guys.
That's okay. I can fix that. And then I sold it. I sold it in October of 2000 and. Well, no. Let me go back on this. I sold it in October of 2005, and the real estate market in Calgary went through the roof in January of 2006. And between October and June, the difference was it was the difference between selling it for $320,000 and $450,000. It was $130,000 in basically 6 months. And keep in mind, I came out of an economics degree, and I was looking at the market going, I'm pretty smart. This thing's got to crash. It makes no sense. Housing prices are too high. Interest rates are too high. Income to price ratio. That's why I always get hung up on income to price ratio. I'm like, there's no way that this thing isn't going to crash. And then the market goes through the roof, and it's never gone back down to where it was. So I made that mistake of trying to time the market, and ultimately sold a condo for way, way, way less than I should have, because I thought I was being smarter than everybody else. And then I think it took another 2 years after that before I jumped back into the market. And I missed out on a pretty significant amount of price gains in the time I was out of it, because I also waited for it to come back down, which it never did.
And that really plays into that statement you made earlier, that it's, and I firmly believe that it's impossible to time the market.
Yep.
Sorry, go ahead.
It doesn't matter when you buy, it's that you buy.
Yeah, 100%.
Sorry, what are you going to say, Nolan?
Oh, and I was a mortgage broker at the time, maybe a year or two into it. And I wanted the absolute lowest rate. So I got myself a nice little variable rate mortgage with something that was new to the industry at that time, a bona fide sale clause. So I made every mistake I possibly could on those first two transactions. It was brutal.
But look at what you learned out of it. Yeah. And now you can pass that knowledge on to your customers so they don't have to make the same mistakes.
Yep, exactly. So and that's the whole thing, right? Like, we have so much collective experience, and people are trying to do this on their first try, and the chances of them getting it right are slim to none. Like, it really is. The chances of a consumer selecting the right bank and then selecting the right product on their own without any help, no matter how much research they do, no matter how many of my 450 videos on YouTube that they watch, it's pretty much impossible that they're going to get it right. So I think our industry has so much more value to bring in the future.
Yep.
I certainly think that technology taking it out and digital companies coming in and helping make people make better decisions is not going to happen, because a computer just cannot understand a person. I don't care what Chat GPT can do. They can't understand a person the way another person can understand a person. And then
absolutely
combine that with the experience of a great broker who genuinely gives a damn about the client that's sitting across the table from them.
Well, and that's it. The big difference between us and it is that we've got this. We've got a heart, right? So, and there again, the experience, you can go through all kinds of logistical things and historical data and everything else, but in the same respect, it's really finding out what people need and giving it to them. We always use the analogy of the doctor too, where, you phone the doctor and say, hey, listen, I got a bellyache. Can you give me some pills? And he goes, no, I have to have you come in here and look at you and check you out and see what your thing is. So that's the key, and that's never going to change either.
Yeah, no, I agree 100%. Cool. Well, I think that's a great way to end off our very first episode. And I'm really looking forward to doing a whole lot more of this with you guys, and looking to learn from both of you as well, because you guys have a lot of amazing insights to share. And we're definitely going to have to all go in on some Ray-Bans so that we can make that.
Yeah, I think we need the sunglasses real. And
I can't see a goddamn thing because I took my glasses off.
At least your picture didn't fall on you this time.
I love it.
Sorry.
Too funny.
This is great. Looking forward to the rest, shows and shows and shows after this. So
amazing. Well, thanks, guys.
All right.
Thanks, Nolan.